a strong retail performance.
Doom and gloom going on.
Very strong year.
They are the most seasoned investor. So hello and welcome to the CRE News Hour, a weekly podcast at 3 p.m. Eastern Standard Time, where we come to you live, discuss the current events and everything commercial real estate. My name is Henry Eisenstein, and as always, I'm here with my co-host, Rafael Cayazo. How you doing, my friend?
What's up, man? You're on a roll with that name. That's awesome. I appreciate you, and I'm excited for today. It's going to be a good discussion, and we'll also talk at the end, I'm sure, about your business seminar that you got going on later tonight. I'm excited to tune in as well. So
appreciate it. Yeah, we're gonna have some fun today. For today's session, obviously, we're going to be talking about a lot of different things, everything you could possibly imagine. We're gonna have some fun today. So wherever you want to start, Rafael, I'm with you.
This is one that I found on Globe Street, as I mentioned before. Globe Street's probably one of my favorite commercial real estate news publication websites. Essentially, this article highlighted the fact that commercial real estate actually fared pretty well, considering the fact 2023 was kind of a down year, quote unquote, but we really didn't experience a significant quote unquote recession, even though we did have a lot of people and news pundits talking about the fact that we would actually go through that period of recession. But as you can kind of see some of these numbers here, third quarter GDP growth actually turned out to be roughly 5.2% when you compare quarter over quarter over the last couple of years, which was a very strong year. And then also the economic delivery for the entire year is going to be roughly about 2.5%, which again, it is not recessionary, right? When you look at it, it does not indicate that we're actually in a recession. On the retail side, obviously, we've talked about it in previous podcasts that there was a strong retail performance, in particular when it came to Black Friday and some of these other shopping days. We were actually slight increase over what you would compare year over year on that front. And then, on the CPI index side, we've started to see a tapering off of the CPI when you compare both the general CPI and also the core index as well. So the economy is quote unquote cooling, yet we still haven't experienced a sizable drop off in economic output. And also on the commercial real estate side, values have not been drastically affected as we would have expected. Obviously, there's certain categories of commercial real estate where the values have been affected drastically, primarily office. But for the most part, delinquency rates are pretty reasonable compared to what you would expect. And then, you kind of go through some of these statistics as well. So this gentleman who wrote this article, or was responsible for this article, was associated with Marcus & Millichap, one of their head economic experts. So it was an interesting article. I don't know if you want to comment on this.
Sort of what we've been talking about, which is there's been a lot of doom and gloom going on in the markets, and this is more data yet again showing you that it is not as bad as everybody's making it out to be. I mean, I love, if you want to scroll up just a little bit, I like where I was talking about the delinquency rates. This goes to show you that, delinquency rates, I think from what I remember, or from
CMBS, are you talking about this?
CMBS delinquency rate of just 4.6% likely beats most people's expectations. Likely, this is a drastic difference from what the entire world has been claiming was quote supposed to happen, right? So I think that this is music to my ears, man. This is of course, it is not as bad as we all thought it was. I mean, look, I think there was maybe a 30 to 60 day period of time where I was like, I really don't know what's about to happen. This could be really bad. This could be really good. Who knows? I was kind of on the fence right now, and we've been saying this for the last, 90 days we've been doing this session. It's long gone. I just do not see the massive amount of foreclosures. I do not see the crazy, terrible, stuff that everyone's putting out in the news all over the place, the fear mongering as actual reality. I think that if you're actually looking at the clean data, the real data, which is what we're looking at right now, I think it tells a very different story than this fear, doom and gloom shit. I think that it's actually going to be, it's definitely been a slower year overall, but I definitely don't think it's going to be as bad as everybody thinks. I think 2024 actually looks pretty damn optimistic.
Absolutely. I couldn't agree more. And, obviously, I think when the market stabilizes, when we know that there likely won't be increases in rates coming forward, that gives people a lot of positivity. And there's a lot of people in the marketplace right now that we talk to on a regular basis that are absolutely positive about the fact of what's going on in the marketplace. So I think, as you said before, 2024 is likely going to be a very strong year. That's what I believe, and I know that's what you believe, and I'm looking forward to seeing what takes place over the next 12 months. But to start out, I wanted to go ahead and go over to your article. So office borrowers navigate tough loan market as Fed urges leniency.
Yeah, I think that this is one of those articles where, if you don't read it through with a fine-tooth comb, it's really going to be, kind of a misdirection again when it comes to the titling, right? Think about titles, guys. Titles are really just to get you to click, right? Like we want you to click on the article. It doesn't mean the article is going to be super specific to what the title is. This is just giving you some guidance that around certain specific asset classes and things that are going into a troubled time. Large office buildings in key A-class markets owned by REITs. The Fed is trying to give them opportunities for the most part where they can, at least to give the lenders saying like, hey, please don't, try to be as easygoing on these types of individuals as possible, right? They don't want to just keep foreclosing and then having these huge assets that are, going through this foreclosure process and then just have a bunch of vacant space all over the place. Like nobody actually wants that. The bank doesn't want the property back. The owner doesn't want to give the property up, but no one, obviously everyone is in the business of making money. So this is just to give you some heads up that like, listen, the only things that I really think that we're going to start having some major issues, which is I love this image, by the way. If you see here, the main part of the graph, all the blue lines, this is loans paid off at maturity, which means they refinance the property, which you can see that a lot of properties, which you can see that difference between all in 2018, 2019, 2020, 2021, 2022. The difference between that percentage and 100 is if they sold it. It went to foreclosure. Okay. Obviously a large percentage of it was sold. If you look in 2023, this is showing that a lot of these loans for office buildings, that's what this is. This is talking about CMBS office loans. They're being sold. They are selling the property off. They are not refinancing because they are struggling to be able to refinance in a positive manner and not be underwater. If you look to the right, you see hotel, industrial, healthcare, mixed use, multifamily, and retail. For the most part, you're seeing a very, very healthy rates across the board. Other than, which I think was very fascinating, is that if you look at mixed use, I think mixed use is the only other asset class that I don't think a lot of people are talking about, which is the smaller to mid-size, mid-use mixed, because they're very hard to get loans on. They've always been very difficult to get loans on. Mixed-use properties have very, very high debt service coverage ratios that you have to have in order to close. And I think that a lot of those are having major issues, especially ones where the mixed use space on the second story is office.
No, I couldn't agree more. To be honest with you, I haven't done a whole lot in the mixed use space. Here in Louisville, it's kind
of
avoid it. Yeah, I haven't had to deal with it for the most part, but you're 100% right. Banks right now are just being very cautious about what they're loaning on, and anything related to an office type of user, that obviously becomes a sticking point. Obviously, go ahead.
I want to mention this. Think about banks like your biggest investor. They are the most seasoned investor in the marketplace. Think about that from that perspective. A bank is not going they want what they want, right? Like think about it from a unlimited financial perspective for an investor. If you could buy any product on planet Earth and have your decision and basically make it where you're making it more difficult for you to buy properties in areas and locations and types of asset classes of properties that you don't want to buy. And you make it easier for properties that you do want to buy, right? Like you just got to pay attention to what the banks are willing to lend on with really simple terms. They want A-class multifamily that cash flows day one. No shit. And they really don't want mixed use or office buildings right now that are struggling to cash flow. Why would they want that?
100%. And obviously, like you said, the way that a lot of these deals get done is through debt. So you're one of the main stakeholders within any transaction is going to be lenders. And so getting familiar with what different lenders operate in the market, what their appetites are. And then obviously, if you want to increase your probability of actually getting a deal done, like you had mentioned before, targeting particular property types that are, attractive to the vast majority of lenders out there. So next up is one that I don't know if you've seen this or not. It was very surprising to me when I saw it, but after reading into it a little bit more, it was something that I figured out. But essentially what they're saying is that new bill is proposing that Wall Street investors get out of the housing market completely. So I don't know if you guys are familiar with the trend that's going on, but a lot of these institutional level investors are coming up and buying swaths of single family homes across the country. I think in the article here, it references that they own, I think 574,000
there you go. Yep.
U.S. single-family homes are owned as a result of just these types of larger investors coming in, buying up swaths of land. There's also a big trend in the United States regarding build-to-rent communities where people come in, buy swaths of land, and then build these homes, and then the only purpose of those homes is to rent them out to long-term renters. And so essentially what this gentleman in Congress is trying to do with in unison with another senator in the Senate is that they're trying to propose a ban on hedge funds buying these homes. And not only that, but over a 10-year period, they would have to sell off at least 10% of their single family home portfolio, over that 10-year period until they essentially get to zero. Now, in theory, you think that it would open up a large proportion of homes for people to buy. And, as a first-time home buyer, I'm sure it would affect their ability to be able to get into the house and hopefully make it somewhat more affordable. The problem with the notion is, and this is what several economists have said, is that some of the incentive of actually going in there, buying land and developing property, part of that, some of the economics to make that work, especially recently, has been holding the property for a period of time. And if you're eliminating that as an option for people to do, then obviously the desire to build these single family home communities drops off significantly. So a lot of people think that this could potentially affect the inventory in the future as well. And so it's kind of like a double-edged sword, I guess. So I don't know what your thoughts are on the matter.
Yeah. This is yet again the government thinking they know better. This is absolute stupidity. Absolute stupidity in my eyes. I think that this is like, why on planet Earth would the government believe that by selling off industrial, like investment grade, like REIT grade assets, right? Like, and I'm talking like even single family like portfolios, massive amount of these houses. That is not the problem. That is not the problem. There is an infinite amount of renters that need housing, just like home buyers, right? This isn't like, there's no reason on planet Earth that they should be thinking that this is the right way to do it. If they want to make sure that there's enough housing, stop taxing people so much freaking money to build these communities. Do massive tax abatements. Give out, offer, like donate. What is it called? The donations from the government where they allow like basically
grants
for the grants. Yeah, offer grants to developers to build these huge tracts of land. Develop these huge tracts of land. Offer them that ability. Don't go, hey, I know you're buying a lot of properties. I'm going to make you sell it for X percent, or X percent of the properties you're buying. I'm going to make you sell all of it and make it available for the regular everyday individual. That's the dumbest thing I've ever heard. Make it easier for us to build properties. Make it cheaper for us to build properties, and investors will build it. Right?
Yeah.
Like it's just absolute stupidity.
Well, I think what they're thinking is that by releasing, 50,000 or 60,000 properties a year into the marketplace, that may affect property values for a little while, and maybe you see a little bit of a drop off and make it affordable for some people. The problem is the long-term effects, because if new money is not coming in to be able to develop these new properties, then in 10 years, it may be even worse of a problem. And, that's kind of the unintended consequences that oftentimes happens when, you think very short-sighted. And oftentimes that's what happens in a lot of these situations.
That's the government for you. Short-sighted as all hell.
Well, hey, I guess when you have a 4-year term, I guess, if you can get it done in 3 to 4 years, then that's all that really matters, right? So
makes no sense.
Yeah. Well, next up is one article from Henry. So mall owner PREIT files for Chapter 11 for second time in 3 years.
Yeah, this is the Pennsylvania REIT. I put this in here just because I thought it was interesting. This is actually a town about an hour south of where I grew up. So I was like, oh, I definitely got to put this in here. So what this is interesting is that this is a massive mall. Okay. I want people to hear this loud and clear. If there is a mall near you, okay, if there is a mall near you, huge, and again, we're talking several 100,000 square foot mall, indoor, outdoor, whatever it is. Okay. A lot of these malls are struggling massively right now. Now, I'm coming here to give you an example where this type of property, I want you to think about this. You, as an everyday average commercial real estate agent or investor who's probably watching this video, it's going to be very rare that we get our little hands on these types of properties. Okay. I'm just going to call a spade a spade. I am not telling you to target malls. Okay. However many times you see these malls coming up as opportunities, the only way that you'd be able to get in on this is if you happen to be close friends with the owner, or because these are huge REITs, multi-billion-dollar organizations. Okay. This is not where I would be spending my time, energy, and effort. I wanted this to just be a reminder that stop trying to go after this type of stuff. The odds of you making a penny on this type of deal, because you know what happens here? Pennsylvania REIT is going to sell this to another REIT that they know and allow them to be able to buy in equity and the stock, for their the privately owned shares. It's just not going to be something an average everyday commercial real estate agent or investor is going to get their hands on. What I recommend is that you find properties that are similar, the smaller mom and pop retail shops, the smaller mom and pop owned industrial buildings, retail buildings, office buildings, the whole gamut in specific key areas that you know fairly well and you have buyers for. Okay. Find the ones that are struggling where there's a massive amount of vacancy and call those people. Use the same philosophy and target those individuals where you're actually going to be able to make some money. Okay.
Yeah.
Just $1 billion organizations are not going to do business with you, or at least right now.
Yeah, 100%. I mean, a lot, like you said, a lot of these REITs have real estate teams. A lot of these REITs have long-standing relationships with these large brokerages. So maybe if you work 30 years in a CBRE or some of these other larger firms, maybe you have access to some of these opportunities. But I think you're right. I mean, I'm obviously very bullish on retail. That's what I predominantly operate in, and especially if you focus on suburban and even core retail centers. But you're right, ones that you can actually access through people who are maybe multi-building owners, but they're more accessible than maybe what a REIT would be at a Fortune 500 type of company. So I think
I'm a fan of the mom and pop stuff. Something between 5,000 and 50,000 square feet, maybe even 100,000 feet that has a massive amounts of vacancy. You're going to be able to find an opportunity where someone's possibly struggling because there's a massive amount of vacancy and no one can go with 50+% vacancy or even 30+% vacancy for that freaking long. So if you end up seeing that, that's an opportunity for you guys to double down on. Which, by the way, I just want to do a quick shout. By the way, if you guys have deals that you would like us to help you underwrite, if you guys have deals anywhere in the country, you come across some good leads and you're like, I wonder how to evaluate this. I don't know. I might not have a buyer for it. You guys can send those deals to us at deals at CREnewshour.com, deals at CREnewshour.com, and just put the address in the subject line, and we'd be more than welcome to help you out.
Absolutely. And if you guys are watching this live, please, engage with us. We're looking forward to hearing your guys' comments. Where are you guys tuning in from? Do you guys have any questions you'd like us to address during this live stream? Feel free to type away, and we'll be sure to answer those questions shortly. So next up is an article that I was somewhat surprised by when I was reading about it. I'd heard about them having some struggles primarily related to a new strategy, or relatively new strategy, that they've been pursuing. But Walgreens credit just got downgraded by Moody's to essentially junk status. So they downgraded it to BA2, which is 2 notches into the high yield category, which essentially is that junk territory. The big reason for that is because there's been a shift in the actual pharmaceutical business where they're offering more healthcare services on site, and that's becoming very capital intensive. And Walgreens has taken on a significant amount of debt to be able to take on this new strategy. And so there's a lot of concern in the marketplace regarding whether or not they're going to be able to pull this off and still be able to service their debt long term. Now, the reason why I find this so fascinating is because I'm sure you've seen it in the marketplace, and many of you guys have seen in the marketplace. You see these Walgreens trading at a 5 cap or a 4.5 cap or some other, lower cap rate. And the sales pitch has always been, oh, well, it's a Walgreens and they stick around for 20, 25 years, whatever else. And it's supposed to be somewhat of a, set it and forget it type of investment. But with the fact that this has come out and now you're essentially dealing with a company that no longer has a strong credit like it did maybe 5 to 10 years ago, what do you think is going to happen to the value of these types of investment properties in the marketplace? It's obviously going to be affected. And so I think there does seem to be opportunity with some of these big box, pharmaceutical companies. You've already seen it in Rite Aids. You probably see 1 or 2 Rite Aids in your market right now that are vacant, right? So these types of vacancies are probably going to continue to happen over the next 5 to 10 years, and there's potentially great opportunity because a lot of these buildings are located in great areas. So
I am curious. I'm just super curious. What didn't Walgreens just buy Rite Aid?
They bought them a little while ago, but then they closed down all the locations, most of them at least, and not all of them. I know they kept some open, but for the most part, they closed up shop. Yeah.
Well, that's what I'm saying. Didn't Walgreens just take over all the Rite Aids that were failing? And CVS is doing it's just interesting how these massive organizations are making decisions. I mean, it just sounds like such a stupid thing to do.
I think they're trying to evolve with the times because right with offering healthcare services, if it actually pays off and you're able,
it's actually smarter.
It is, because I mean you're playing in a very low margin industry when you're just talking about convenience store items. You're essentially you need it, and the pharmaceutical business, again, I would imagine it's somewhat of a low margin business because again, so what they're trying to do now is they're trying to go into verticals that are a little bit more profitable. And again, in order to do that and shift your business model almost completely, although they have some of the same infrastructure that you would need to provide those services, but again, there's a lot of things that need to be built out. And in order to do that, they've taken on a massive amount of debt. So
I'm going to go on a whim and say this. I think that Walgreens for the next 12 to 24 months is going to be a little rocky. But if they really figure this shit out, if they figure this out on the healthcare space, on this kind of side, I think they're going to do unbelievably well long term.
That's the hope. I think that is what people are kind of questioning right now. And obviously another thing that we didn't even mention is that they had to deal with opioid liabilities. So I'm sure you've seen lawsuits.
I saw that.
You've seen
What's
lawsuits.
that all about?
I mean, what's the company that was responsible for not Percocet, but essentially, Penn, I think, is the name of the company. I can't remember the exact name of it, but they got sued for billions and billions of dollars. And then obviously a lot of these pharmaceutical companies that have been administering these types of opioids have gotten up in these class action lawsuits. And obviously Walgreens got picked up in it. CVS is probably dealing with it as well. So, again, I think it's just a culmination of a lot of things happening at once that's causing this to happen. But the hope is, like you said, if they're able to execute the strategy efficiently, then I think they'll be great going forward. But when you're dealing in the triple net investment market and you're trying to sell this property to someone and you get news like this that says they're in the junk bond territory level, that is kind of concerning. And so I'm sure cap rates for these types of assets are going to go higher. So potential opportunities there.
Definitely. Yeah. I think that, for those of you who have clients or, you've come across your an average Walgreens every now and again, it might be a good idea to reach out to them and send them that article and just be like, hey, just want to give you a quick FYI, want to make sure everything's okay. And if you do want to sell it, I mean, we could probably get you, get you out from underneath what might be.
Yep, absolutely. All right. So next up is the Fed announces new grants for nationwide high-speed rail pipeline projects.
Okay, I love this article because I think this is another great example, similar to what we were talking about for the development of the new Universal Studios amusement park out in Texas. This to me is like, hey, if you're an average mom and pop investor, okay, I'm talking to you, you're a small time investor, you're a real estate agent, want to start investing, find where the development opportunities are and go ham and buy a few multifamilies right in that local area. Okay, because there's going to be people who want to be living right near these. This is an example, the rail lines, right? The rail lines are not going to be going anywhere, right? Especially once they're built, they're only going to get more and more popular. So I think it's an interesting opportunity, especially the one that I don't know if you let's see, it's right here. It says it was the one that was Los Angeles to, these are all the other ones that they're thinking about.
Yeah, I'll pull up. Let me go up so you can see.
Yeah. There's one that was like the LA to Vegas.
LA to Vegas. Yeah, right there. Yeah,
I mean, that is going to be that's going to be huge. I mean, how many people are freaking making that trip, right? So to make that available, I mean, because they actually have a bright line here in Miami that goes all the way to Orlando.
Yeah.
Right. And I'm taking it to when we have a conference in Orlando early next month. And we're going to take that. So it's like, this is a huge opportunity. We're like, hey, if you're buying some multifamilies and you want to know what locations you should be buying at, find out where these rails are going and, freaking buy a 4-family, a 2-family, a 10-unit, whatever, right next to these rail lines. And you're going to be doing okay over time.
Yeah, absolutely. And, obviously, I don't know if you've traveled to Europe. If you have, obviously, you've been on the rail systems over there. It's absolutely phenomenal. It's super convenient. You can literally hop from one place to another. When I lived in DC, obviously that was more of a metro type of system. But, what this opens up to is work opportunities for people outside of just the Miami area or Phoenix area or, New Orleans, all these other places. And so you're probably going to see a lot of people, too, that choose to live in maybe lower price markets that can now commute into town. So from Phoenix to Tucson, for example, if you're driving, it's an hour and a half drive. So, if you figure in a high-speed rail situation, which I'm not sure if this particular rail is going to be high-speed or not.
They're saying they're going to go 150 to 200 miles an hour.
Yeah, so you get into Phoenix in an hour, maybe. 50 minutes. So like that's
Unbelievable.
an unbelievably easy commute. And if I'm someone who says, okay, well, instead of me maybe living in Phoenix, maybe now I can have flexibility to live in a smaller market like a Tucson, that obviously opens up opportunities for subsidiary markets where this is leading to. So, Miami to Orlando, for example. Orlando's still a very hot market, but I'd imagine that there's not nearly as much growth in Orlando as there is in Miami. So hopefully some of that transitions over to Orlando as well. So again, it's going to benefit all markets, but look to some of the connecting.
Yeah, pay attention. Just pay attention and figure out, even like I would even pay attention to some of like the end caps, right? Like where's it going? Like those two end cap areas are probably going to be big market areas, right? Like you're going to be wanting, obviously, like as an example, Miami to Orlando, like two big cap areas. And even if you're like one stop out of it, I think you're going to find some opportunities for you to invest and make some good money.
Definitely could agree more. All right. So next up is a resource that I would highly encourage you guys to look at. Obviously, you probably heard us talk about the consumer price index a lot on this show. It's a very important metric that the Fed follows to kind of determine how they're going to implement their policy. This is the website that you can go to. So it's bls.gov/CPI. And as a result, it references here that the CPI for all items rose roughly 0.1% in November, and shelter being kind of the main driver for that. And you can download the PDF and actually dive into each of the metrics so that you can see what's actually being affected. Because a lot of times you see, oh, well, the CPI went up by 0.5%, but maybe that's isolated to maybe just one category that brings up the entire average. And that's why you've really got to get an understanding of, what does this number mean? Just because you read it in a headline doesn't actually mean that it's actually manifesting in the marketplace like you would think it would. So again, this goes through each and every category: food, energy, all other items except energy, seasonally adjusted CPI metrics, because obviously there may be a higher buy activity at the end of the year and in November, December. So you have to adjust it for seasonality. So again, there's much more nuance to the actual analysis of the CPI than you would just read in a headline. So again, I just wanted to make sure that you guys were aware of where it is.
I like this a lot.
This is so it's bls.gov/CPI, and you just go there and it'll tell it if there's a new release, it'll post it there. You just go to the PDF or HTML, whatever format you want to read it in. Obviously, you can do so. It has an RSS feed too. Wow, so you can maybe even link to it. I haven't explored that at all, but it's pretty cool.
Yeah, I think that this is a good opportunity for us to like really be paying a little bit more attention than just letting the news do the work, right? Because what happens is that the news, what they'll do is they're going to put out one article and they're going to be like, hey, the CPI is at X, right? Like, and you're going to be like, oh my God, the CPI, is super high, is super low, whatever it comes out to be, right? And you're just going to take their word for it that it might be an issue, might not be an issue, right? But when you actually are paying attention, doing the due diligence yourself, which does not take long, people, we're saying take 10, 15 minutes once a week just to kind of get an understanding about what's going on in the economy. Go to some of these news articles and you can actually be paying attention like, oh, okay, wow. Like the 12-month percentage change between consumer price index is actually really, for energy, it's actually down 5%, 5.5%?
5%, yeah. So,
it really helps you pay attention to certain things and really understand like what is actually important to pay attention to versus what's not important to pay attention to.
Yeah, 100%. And again, it provides more color to the discussion because, again, what we want to avoid in any scenario is that we just take people's word for it without verifying the information ourselves because, at the end of the day, the people that you service in the marketplace are going to be reliant on you to share insights and information. And you need to be a little bit more nuanced when it comes to analyzing this information so you can best serve your clients or whoever you decide to serve. So, all right. So next up is demand for retail space. So demand for retail space hits record high in the United States.
Yeah, we had touched on this, I think, about a month ago, which was saying, retail was really moving up in a really great direction. I think this is a really cool thing to see, which is why I'm trying to talk about the whole mall situation, because it's like there's so much misinformation unless you're really paying attention to what this means, right? It's like tenants continue to fill retail space across the United States. This is saying that the net change in demand versus millions of square feet, right? They're saying that the demand right now is, 15 million, right, is what the demand is. And 14 million is the net change, right? Is that what it's showing here, or is that the average?
That's the net change in demand.
Yeah. So here, scroll down a little bit.
Yeah, I can do that real quick. So,
So
are you looking for this right here?
yeah. So it just is, again, just trying to show you. So this is what's interesting.
Oh, wow, nice.
A large portion of all of this, like if you look at the malls are getting decimated. And again, this is the prior 4-quarter change in demand in millions of square feet. There's 4.5 million less square feet in demand at malls, but there's in freestanding. So this means single tenant. Okay, freestanding, small little pad. Right, freestanding. There's 45. What is that? 45 million square feet in demand right now. Right. 20.1. This is 21 million square feet worth of demand in the neighborhood shopping centers, which is like the small, 3-store, 6-store, 10-store little baby shopping centers in your local area. Power centers and major strip centers, those are like the 20,000, 50,000, 200,000 square foot retail centers. You're seeing a much lower demand. So it's like, think about it. If you're looking at buying a retail center, if you're working with an investor to find a retail center, it might make sense to buy a little bit smaller than it is to buy a little bit larger, right? Obviously, this is just stuff this is why I really like this too, is that the average everyday individual in the commercial real estate world and investors can get in the game for small freestanding stuff and the neighborhood center stuff much easier than they can in the mall world or in the major power centers.
Yeah. 100%. And also not just the actual freestanding buildings. Obviously, that's very much and I would 100% agree with you. Freestanding, especially if it's in a great area, I mean, it's super competitive. But land too. I mean, retail land is very lucrative. I mean, I've sold a couple acres. So 1 acre of land over $1 million, another acre of land, $1.5 million in sales for just one acre. But it's obviously located in a phenomenal area. And so if you have these types of clientele that you work with, like the car washes or the banks, for surprisingly, they're paying a significant amount of money. If it's well located, it's got some great visibility, could be phenomenal potential buyer. Another person to consider is a lot of the fast food restaurant concepts. They're always wanting to be located in phenomenal areas with high traffic counts. Access and visibility is huge for them as well. So if you can find these opportunities in the land space, it could also be a big opportunity for you to be able to make quite a bit of money in the space. So,
yeah.
The next article is actually based on a ULI report that was circulated. It's a yearly ULI report, but essentially the highlight is, will the commercial real estate market hit the reset button in 2024? So, as I mentioned before, it's based on the emerging trends in real estate. That's a ULI report. You could follow it, ULI, and actually access the PDF file. But essentially what they talk about is the focus area on a variety of different factors. So obviously retail has rebounded significantly. So in the report, it kind of highlights the sunlight that is retail. So I think that they're going to consider that in 2024, again, it will continue to be strong as far as a property type. Hybrid work isn't going anywhere. That's kind of a trend we're already seeing. There's a lot of office users who have now decided to say, well, we're going to go back in the office, but maybe just 2 days a week or 3 days a week. So we're not going to nearly have as much demand for office space. They think that trend is going to continue in 2024. The Sun Belt they believe is kind of the main beneficiary of the future. So the markets to watch, if you go into the report, it'll actually show you all the different cities that they targeted. The usual suspects are on there, the Miamis, the Austins, the Nashvilles. Obviously, there's several markets in Texas that are very hot as well. And that's all based on the fact that they operate within that Sun Belt. And again, that's where a lot of people are moving to. Those trends, again, debt comes to the forefront. So there's a lot of users out there that have a lot of debt that is coming due. There's still a lot of speculation as to what's going to happen. We talked a little bit about this early in the podcast, that the Fed may stopgap some of these larger institutional investors when it comes to office real estate. But again, we still don't know how it's all going to play out, but 2024 will definitely enlighten us. Number 5 is AI advancements to commercial real estate attention. So, again, I've seen some technologies that implement AI in the commercial real estate space. There hasn't been nearly as much as of yet, but it will become much more prevalent in 2024 and beyond. And then, we could go into some of these other items, but I won't. I'll spare you guys. But again, this report's phenomenal. I actually went through the entire report, and there's a lot of really great insights. So, if you're looking for ideas for content, or maybe you just want to get more apprised on what the broader landscape looks like for 2024, I would highly encourage you guys to check it out. So,
great article.
Henry. Yeah.
Yeah,
It's really
great article. I think that, I've been talking to a lot of my lenders who do a lot of business, hundreds of millions, if not billions of dollars in production between them. And a lot of them are very optimistic in the new year. A lot of them are very optimistic with rates coming down or proposed to be coming down. I just dropped down. I know the date says the wrong thing, November 29th, but it's actually for today's actual interest rates as of today. We're in the sixes, right? Like we're comfortably in the sixes. They've been mentioning to me that we're probably, we're in the mid sixes for people who are fairly highly qualified. And obviously the DCR, debt service coverage ratios are good. They're going to be giving us some decent interest rates. So I'm pretty optimistic above everything else. I love articles like this. I think this is a really good opportunity for people to also be paying attention to the fact that, like, hey, if you're working with an investor and your local market sucks, just to call a spade, like if your local market is tough, if your local market doesn't have a lot of inventory, I coach agents all over the country. And if you're in the middle of nowhere, which it's okay, wherever you grow up, it's fine. But like if you're if you grow up in a town where you got 2,000 people and you want to be a commercial real estate agent, you are going to have a tough time, my friend, right? You need to be able to expand into higher production markets, right? And this is a perfect opportunity to say, like, hey, especially if you can get your license, and like, hey, if you're hypothetically an agent who's licensed in Georgia, right? Or let's even take a crazier example. Let's say you're licensed in the Dakotas, North or South Dakota, okay? And you're in the middle, you're in an area where you got 2,000 people who grow up in your town, and you want to be a commercial real estate agent. Get licensed in Texas, Florida, Nashville. Get licensed in these other states and call in those states. You can call all over the freaking country, right? It's like, stop being, focused on just what's in your backyard if your backyard is really freaking difficult, right? It's like you have an opportunity if you pass it, especially because now if you're licensed in all these other states, there's actually some other states where you have complete law of reciprocity to just be able to sell in other states, right? Once very easy way to get your license. So just keep in mind, like, I love articles like this. I think it's important for people to just realize, like, listen, just because you're born somewhere doesn't mean you just sell somewhere, right? That's not just, those things do not have to be correlated.
100%. And regarding being licensed in some of those states, you don't even necessarily have to be licensed in one of those states as long as you hang your license with a broker of record in those markets. So, for example, I'm doing a transaction in Ohio right now. I'm not licensed in Ohio, but we're dealing with a broker of record in that state, and they'll take a small fee. But again, if you're talking about a decent sized deal, the small fee is pennies compared to what you actually are going to get benefit. So, I would encourage you guys to try to get licensed in these different states. Obviously, there's CE requirements and other things that you have to take into consideration as you're getting licensed. But if you're just trying to do a deal in the market, you don't necessarily have to be licensed in it in order to transact. So, don't let that discourage you if you say, oh my gosh, I have to take 120 hours of coursework. It's like, you may not need to, as long as you operate with a broker of record in that state. So, just thought
Beautiful.
I'd share that.
No,
insight.
sure. You want to dive into some comments real quick?
Let's do it before we dive into the second part. So, Court, so he says, from Jacksonville, Florida, new to your channel and very new to commercial real estate, but looking to learn and get advice. Thank you. Welcome, man.
Yeah. Thanks for tuning in. We appreciate you.
Yeah, absolutely.
Good luck in the career.
Absolutely. And Henry's got a webinar tonight that you may consider joining if you are interested in learning more about how to grow your commercial real estate business going forward. So definitely keep that in mind.
Appreciate that. Yep. 6:30 p.m. Eastern Standard Time tonight. Business planning and goal setting workshop. If you are ready to dominate in 2024, all the information is on my social media. So you guys should just check that out. And hopefully, and by the way, we are live streaming. So if you guys just go on my YouTube channel, you'll see the live stream link.
Absolutely. All right. So next up is Eduardo. He says, how do you find out how much value will increase the market with new structures such as a new railroad?
Great question, by the way. Great question. I think that what's important to pay attention to is that you can look at two things. Number one, you can look at rental values and how they've increased over time. You can look at things like even Redfin.com has some really good data in regards to home sales, like the increases over time. And Zillow even has the you can see trends on certain properties of how the rental markets have increased over time. Because think about it like this: if rental, let's just say rental values right now in a building you're looking at, you have a 4-family property that you're going to pick up for 400 grand. Okay, I'm making up numbers. I don't know if that's cheap or expensive in your markets, but anyways, you have a 4-family property in a place where there's a rail that's going to be going up. Okay, what you can see though is that the demand for that area is probably going to increase. And the value of that 2-bedroom apartment, right? Which might right now be $1,000. In 2 or 3 or 4 short years, you might be able to all of a sudden go from 1,000 to 1,200, 1,400, 1,600, 1,800, right? All of a sudden, you're going to be doubling the rents in a 5-year period of time, which is very unheard of, right? But it's because you're paying attention to the demand of what will be in those markets. So there's not an exact science to it, but you guys can start seeing the trends from past histories to predict the future.
Absolutely. And if you're dealing in small multifamily, as we all know, commercial real estate is based on the income it produces. That's the value. That's how you determine its value. So, in a market where you have a trending of upward of rental rates, in particular, if you are located to some of these newer developments, maybe like we had talked about, maybe a new employment center that's being developed near you that's going to generate a lot of employment. You had mentioned on the previous podcast that there's a place in New Jersey that's now being developed into an office structure for a big company. That's obviously going to benefit the investments nearby because employers are going to need a place to stay and live, and that's going to drive rents up. Same thing goes for these types of infrastructure projects because, again, it's going to create a flow of people that are coming through the area, and that's going to necessitate not only residential, but essentially at some point commercial activity as well. So maybe strip centers, finding those areas where there's high traffic areas, those can be also great opportunities when you have these infrastructure projects that go in. So hope that answers your question, Eduardo. And he said he's tuning in from San Bernardino, California.
Love it. Hope it's beautiful out there, my friend. It's a little rainy here in Miami today.
Mm-hmm. Yeah, California's got beautiful weather, man. I mean, I've been all over California, but yeah, I'm looking forward to checking out. What's up?
I was gonna say it's the weather tax that you pay.
It's the weather tax, yeah, that and everything else that you do over there for sure. But yeah, I'm looking forward to eventually getting to Miami. So I was able to find a deal to kind of analyze at a high level. This is something that I just found on LoopNet, so this is not something that I executed CAs for. But again, the logic is still the same. So we're going to go ahead and pull up this particular property that's in Johnstown, Ohio. It is a multi, not a multi. It's actually a sale and leaseback investment property. They just executed an 8-year lease with the owner of the building, which is a large company. They occupy 125,500 square feet as far as the industrial building is concerned. They're advertising it as a 6.81 cap rate. Apparently, they had an addition of 75,000 square feet. They had a 10-year, 100% tax abatement on the new improvements, which, again, if it's truly a triple net investment opportunity, not sure if that really benefits the NOI, but if for some reason you're able to get a new tenant in there, maybe that helps you. But in reality, what it comes down to is this is an 8-year lease. And so what I ended up doing is I'm part of the CCIM Institute, so I was able to access their sheet as far as did I not share? Oh, I'm sorry. I think I missed sharing. So here, let me share this again quick just so you guys can see. It is a 125,500 square foot industrial building in Johnstown, Ohio, roughly $12.9 million. The cap rate is 6.81%. And then obviously it's a national credit tenant. They just created an addition of 75,000 square feet, which, again, you would think bode well for their commitment to the area. You wouldn't necessarily just build a 75,000 square foot addition if you weren't doing well. And so that's kind of the logic behind offering it a 6.81% cap rate. So what we're going to go ahead and do now is I'm going to go ahead and jump into the analysis piece. This is a document that I got from the CCIM Institute. If you guys aren't affiliated, I would highly encourage you guys to do so. Not only do they have phenomenal education, but they also provide you with tools that you can leverage to be able to underwrite these commercial real estate opportunities. And so I just essentially took all the information that this brochure had and plugged it into the Excel sheet. So as you can see here, the $12.9 million purchase price. As far as acquisition costs are concerned, I made this a percentage, like 0.25% of the entire transaction or the purchase price. It could be a little bit more, it could be a little less. But again, you just make these assumptions. So you can see something related to, you're going to have a $10.3 million mortgage, and your initial investment, if it is in fact going to be 20%, which it may or may not, so you'd have to toggle around with that a little bit, will be 2.612 million. So as you can see, I use the cap rate of 6.81 to determine what the actual rental income is. Obviously, that's assuming that is the fact. You're going to want to do your own underwriting where you sign a non-disclosure agreement and then you get the actual financials and the leases from the individual. But again, this just is a high level analysis that we're looking into. The vacancy and credit loss, typically when I do my underwritings, depending on the property type, if it's like an industrial property that's been around for a long period of time, they have a long-term lease in place, maybe that vacancy credit loss is maybe 3 to 5%. If it's one that you have a lot more vacancy, maybe it's like a small strip center that has 2 or 3 that are vacant, maybe I'll do a 10 or 15% vacancy. It's all case specific. But again, we're assuming this is all a triple net investment opportunity, so there's no expenses that are incurred by the landlord. The only fees that could potentially be incurred are maybe legal fees regarding accounting and that sort of thing. And then I just set aside $1,000 a year just for miscellaneous things. So what you end up seeing is that it's obviously losing money every month at this price. And the reason is, if you look at the actual mortgage data, we're looking at a 20-year amortization, 5-year term at a 7.5% interest rate. So if you were to toggle around with this, I know we had talked about interest rates dropping off a bit. Let's say that it drops to 7%. How does that actually affect the investment opportunity? Well, you're still in negative cash flow territory, which is obviously not good. You don't want to be losing money every month when it comes to the actual cash flows. And so, this is just additional layers of underwriting that you can check out. So, there may be reduction in tax liability as a result of you taking in a loss. So your cash flow after taxes is going to be, negative $73,000 every year. Again, not a good situation.
What again, if you changed it, let's just say you change it to 20, let's just do a 30% down payment.
Yeah.
Or maybe 35%.
Yeah. Let's put that in. 30. So yeah, you're almost breaking even at a down payment.
Yeah. And this is at a 7% interest, but then so it's think about how crazy this is. What's fascinating, guys, is this is why, when you're looking at deals today, what I think is super fascinating is you did it at a 6.81% cap rate. If you go back to the income page, scroll up to the income number. If you did 7.5%, let's say, because we got to change around some numbers to see where we start cash flowing. This is a negative cash flow deal. We don't even cash flow $1. We are negative 10 some plus $1,000, which honestly I think it's more because you're obviously not probably management and other things you might have here. But so long story short is that you're losing a ton of money because you're just putting down $3 or $4 million, whatever the down payment comes to.
Yeah, $4 million almost. Yeah,
$4 million plus probably $250,000 in closing fees and other things like that, right? So it's you're losing you spent $4 million to make negative 10 or 20 grand. That's the dumbest investment ever. So why don't we change the purchase price? Let's play around with this. Let's change the purchase price to $10 million. Let's say we did 10 million, same everything else. Let's see where we're at. Scroll down. Hold on. The income is way off.
That's why here. That's because I put $1 million. So
yeah, at a 0.
And actually, let me do this real quick because I got to make sure that I have the right income. I want to make sure that it's 7.
Well, here I'll even just tell you the number,
and then we can do 10 million, and then we'll put
12.9 times 6.81.
There we go.
Yep.
So now you're talking at least a little bit of cash flow.
So think about it like this, right? Now I would also do acquisitions fees, probably 150 grand, and then I would do for the only other thing is where that says 5% for PRI. I would probably change it to 7.5%. I don't know if you can change that. Because what I want to show you here, guys, is these are the types of deals that Raphael and myself come across all the time. It's they're asking 12.9, but we just underwrote this at $10 million. Same income, which by the way, this is freaking nuts. Think about this. At $10 million, it's an 8.8 cap. It's an 8.8 cap. And based off of a 30% down payment, which is normal at 7% interest, you're still only making $150,000 a year in income. On a $4 million, how much money down? $3 million?
Three and change. Yep.
So you're making
plus 150 in closing costs. You're in it for $3.3 million to make $157,000 for the year.
Yeah. So it's so you're making not even a 5% cash on cash return. People want a little bit higher cash on cash return. So it's it's an 8.5 cap or an 8 cap. It's not that good of an investment. It only tells such a small piece of the story. I think that we would probably make sense of this deal. I would probably, what would be this deal at 8 mil?
8 million.
Let's go down to 8 mil. Let's do an $8 million deal.
But now
so hold on. So I'm bringing in net almost, let's say 280. What's my down payment total? $2.5 million. Great. I'm cash flowing over 10%. I'm very excited about this deal. And my price per square foot, by the way, at $8 million bucks, 125,000, 8 million divided by 125,000 square feet. I'm at $64 a foot. I'm liking this deal. I'm definitely below replacement cost. I'm cash flowing 10+% a year, day one, all day long. Because the other thing is that, like, think about it. You know, this tenant's only locked for 8 years.
Yeah, 8 years. They just signed an 8-year lease. So
Yeah,
there's and you'd have to look at the lease to determine what, you know, their commitment level is or whatever else. But you're right. I mean, they're only locked in for 8 years. So you can't assume that they're going to renew. Obviously, you could infer whatever you want, but in reality, the only commitment they have is 8 years. And you still have to do get an understanding of how strong the tenant is too, because, you know, you have to cover your downside risk.
Yeah, so think about how crazy this is. You'd have to buy this deal. What's the cap rate right now? A 10, almost 11 cap. It's an almost 11 cap deal to cash flow about 10%. To get this to, like, let's do an exact, let's say 9 million. Can you just do one more time? 9 million. Okay, 9 million, $2.9 million down, give or take a couple bucks. $2.9 million down, and my net cash flow is 223,000. That means 223 divided by 2.9 million. That's not even an 8% cash on cash return. This is how freaking nuts it is right now. Because of the 7% debt, because of 7% debt payment interest right now, that's what's causing the issues. So it's like, this is why people need to be paying attention. Like, hey, just because you're finding an 8 cap doesn't mean it's a steal, people. Unless someone's putting down 50%, which nobody wants to do, right? This is super helpful.
And you look at your internal rate of return too, which, you know, obviously is a very important metric in commercial real estate. And, you know, you have these for different scenarios. So if you were to sell at a 7 cap after 10 years, or an 8 cap after 10 years, or a 9 cap after 10 years, that's obviously going to affect your internal rate of return. And then you have to look at the after-tax internal rate of return. So if you look at the best case scenario of this investment over a 10-year period, you're making 14% on your money year over year, which is not a bad investment, but again,
it's not great. My teams and all the investors I work with are 20 IRRs.
We look for 20s. That's super strong. That's strong. That's very strong.
Everything we look at is 20s. When we see a 20, we're happy. Like, that's our minimum metric. So it's like, guys, it's like when you're paying attention to this type of stuff and you're only seeing an IRR of something like 14%. And by the way, I know we're being conservative. I know that. But it should be on a conservative basis. Make it 20 plus for you guys to have a very good instance of, like, this is a good deal. I know I can sell this all day long. 14s, especially after 10 years, it's like, that's if, in 10 years, by the way, that's not that's also implying that the tenant renews and you have no vacancy.
And again, if they renew in year 8 and then they sign a 5-year lease, by the time you decide to sell in year 10, there's only 3-year leases remaining. It's like, it becomes a lot harder to trade at that point, because people are like, oh, well, they're only going to be potentially around for 3 years, and I don't want to be stuck with 125,000 square foot building if they decide not to renew. So again, you could be hamstrung a little bit in that situation. So you just got to think of all these different scenarios when you're making these investments. And that's why, like Henry was saying, if you can get it to cash flow at a proper rate over a relatively short period of time, that's a better scenario for you in the long run. So
yeah, we like buying deals with heavy cash flow day one. And by the way, you know who also likes to do that? Every investor in every bank. Heavy cash flow day one, you will be able to sell a property much easier. Other than that, we appreciate you guys a lot. We come to you live each and every single Wednesday, 3 p.m. Eastern Standard Time, to talk about everything commercial real estate and current events of today. So other than that, I guess we're ready to wrap.
Sounds good. Well, thanks again, guys, for tuning in. Again, like Henry said, we're here every Wednesday at 3 p.m. Eastern Standard Times. We really do appreciate the support. Please like and subscribe to both of our channels. Obviously, that's a big reason why we do this, is we want to make sure we reach the broadest audience possible. And by doing that, that means we need to engage with the broadest audience possible as well. So please like and subscribe, and I guess we'll see you all next week.
See you guys next week. Take care.